Hello students, welcome to my live teaching learning session of MMPC003 Business Environment. Today we will discuss about Block 2 Unit 5 Indian Financial System. It means what is the system of India's finance sector and what are the components which are included in Indian financial system. So in this session, we will understand the whole financial system, either it may be related to short time period or long time period, and financial system which may be organized, unorganized, private financial system, public sector financial system, all categories of financial system you will understand in today's session. So in this session, first of all, financial system. Financial system is based on savers, users, financial institutions, and financial markets. You know that finance is the main instrument of whole economic activities. Without finance, production can't be happen. If we want to do production or we want to produce goods and services, then we need finance. And whole organizations, those who are engaged in producing goods and services, they need money or finance. So finance is the basic requirement of each and every business enterprises. Without finance, nothing can be happen. So financial system, how financial system works? Financial system depends upon so many things. First of all, saving. Saving is very necessary for doing investment. And savers and investors are different persons. Savers are those persons who save their money. Generally, households give more contribution in savings, and firm sector also give contribution in saving, but less than household sector, because firm sector invest whole amount of money, whatever they earn from their business enterprises, they further reinvest in their business enterprises for producing goods and services. And the contribution of government is also very less in savings. It means the whole contribution in saving is provided by household sector. Saving is a function of many variables, but generally saving is the main function of income. Saving depends upon income. If income rises, saving will also rise. If income falls, saving will fall. And saving is that part of our money income which is not spent on consumption. So saving is equals to income minus consumption. Or we can say that saving is the function of income. And saving is generally depends upon so many variables. And funds can be transferred between users and savers, maybe directly or indirectly. Because savers are those persons who have surplus money and they are not using their money. They want to save their money and want to get interest in return. So funds can be transferred between users who actually use money, who actually invest that money in business enterprises and in the production of goods and services, and savers are those persons who save their money for taking interest in return, and they have surplus money. That's why they can save their money in banks and any other securities or in any other instruments of financial market. So funds can be easily transferred between users and savers, maybe directly or indirectly. So financial system mainly tells us about savers, users, financial institutions, and financial market. And in this, saving is the function of many variable, but in simple words, saving is the main function of income. And when income is zero and consumption can never be zero, at that time saving will be negative. So saving may be negative, saving may be zero, and saving may be higher. Depends upon the level of income. As well as income rises, saving also rises. But saving only not depends upon the level of income. Saving depends upon rate of interest also. And saving depends upon willingness to save. Saving depends upon capacity to save. So saving depends upon so many variables. Not only one variable affects the saving. Saving depends upon income, saving depends upon rate of interest, saving depends upon our willingness to save, saving depends upon our capacity to save, our ability to save, and saving depends upon foresightedness. If we are giving more preference to future, then we will save more money. And if we are not giving more preference to future, we are giving more preference to present time period, then we will save less money. And investment depends upon saving. If saving rises, investment will also rise. If saving falls, investment will also falls. So savers and users fund transfer from savers to users. It may be directly or indirectly. Now next is the basics of the financial system. In this financial system, here in between there are financial intermediaries. Financial intermediaries work as a middleman which work in between of lenders and borrowers. Now lenders are those person who have surplus money, they invest it or keep it in a financial intermediary. And borrowers are those person who borrow money from the lender or from the intermediaries. Why they borrow money? They want to use this money in their business enterprises. So money in between of lenders and borrowers who works financial intermediaries. So financial intermediaries work in between of lenders and borrowers. And lenders, those who have surplus money, they lend their money in financial market, and financial market provide this money to the borrowers or to the needy person who need that money for their business enterprises and for their other purposes. And lenders provide money to the financial intermediaries, and in return, lenders get interest. Borrowers can take money from the financial intermediaries, and borrowers have to pay interest to the financial intermediaries. Financing may be directly or indirectly. So this is the basics of financial system, in which three main things you must have to understand. One is lenders, second is borrowers, and third is financial intermediaries who works in between of lenders and borrowers. Now next is Indian financial system and overview. It means what are the different phases of Indian financial system. Indian financial system phases can be categorized or classified into 4 stages. One is the time period of 1951. Up to 1951 or before independence, mainly private sector. Whole financial system was under in private hands. After 1951 to 1990, That time period is known as pre-reform period. And in this time period, public sector, public sector play a very important role, and the whole financial system was in hand of public sector. And after post-reform or in 1991 or post-reform period, in this when government made privatization and globalization in this policy, then privatization, government gave more emphasis on private sectors and public sector role decreases at that time. At that time, government promote private sector for their efficiently work and for their optimum utilization of resources. And at present time period, we all are living in a globalized world. At present, globalization is the main thing which is improving the integral relationship with rest of the world. So in these four phases, we can understand that at the time of 1951 or before this time period, all the financial system worked under private sector. 1951 to 1990, public sector played very important role, and early 1990s, 91, privatization played very important role, and at present status, globalization era or globalization world, we are living in this stage. So at present, whole Indian financial system is privatized. Very few sectors are in hand of public sector. Now next is 1951 to 1990 time period. You know that before 1951, unorganized or non-institutional sources of finance were prevailing in Indian financial market system. Money lenders ruled till 1951. No worthwhile banks at that time. Industries mainly depended upon their own money. 1951 onwards, 5-year plan commenced. And these 5-year plans start from 1951 to 1956, 56 to 61, 61 to 66, and 66 to 69 there is a gap. Then again continuously 5-year plans going on. Now next is but at present, instead of this 5-year planning, at present which system is working on? Niti Aayog. Niti Aayog is working on, and at present planning system has been abolished. And private sector, you know that Indian economic system is a mixed economic system. And mixed economic system is that system in which public sector and private sector both are coexist in it. So private sectors and public sectors both work together and in a mixed economy. But in India, there is not the equal proportion of private sector and public sector role. Before independence, private sector role was very important. After independence, public sector role was very important. But at present, again private sector play very important role and public sector role is less in present time period. So in a first 5-year plan which commenced in 1951, that planned economic process followed by Indian economy as part of alignment of financial system, priorities laid down by government policies. The main elements of financial organizations are: one is public ownership of financial institutions, strengthening of institutional structure, protection to investors, participation in corporate management, and organizational deficiencies. So these are the main elements of financial organization, in which public ownership was the main thing, because at that time all the financial market was controlled and organized or run by public sector. And strengthening of institutional structure, protection to investors, and participation in corporate management and organizational deficiencies, all these things are included in financial organization. Now, next is features of financial system. It means what are the main features of India's financial system. You know that in India there is a mixed economic system in which public and private sector both are coexist in it. Either it may be in education sector or in a banking sector or in a other producing sector. Both public and private sector are playing very important role. So financial system play very important role, very vital role in economic development of the country. You know, without finance, we can't run economic activities and any activity smoothly. So it play a very vital role in economic development of the country. It encourages savings and investment. And to break vicious circle of poverty, investment is very necessary. Without investment, without capital formation, we can't break vicious circle of poverty. We know that in India, some people are in a grip of poverty. They are living below poverty line. And how they can break their vicious circle of poverty, because we know that poverty breeds itself, and poverty circle can be break down with the help of capital formation or investment. So financial system encourages both savings and investment. It helps in capital formation, and capital formation means addition in new capital stocks, addition in new capital or fixed assets like land, building, machines, equipments, inventories, etc. It helps in allocation of risk, and it facilitates expansion of financial markets. So these are the important features of financial system. This financial system, if financial system is very good in our country, then definitely achievement of economic development. If financial system is well organized, then savings and investment will encourage, and all the funds will be mobilized in economy and fully utilize or optimum utilize for the production of goods and services. So financial system helps in allocation of risk. Allocation means distribution of risk. Risk can be distributed so that only single person will not bear the whole risk. Risk can be diversified, risk can be allocated or distributed among different persons. And it facilitates the expansion of financial markets. Next is types of financial markets and financial system. What are the various types of financial system? Financial system can be broadly categorized into two parts. One is capital market and other is money market. Capital market is that market which provide funds for the longer time period, and money market is that market which provide funds for the short time period. So this is the basic difference between capital market and money market. Capital market provide long-term funds and money market provide short-term funds. Under capital market, we include equity market and debt market. Equity market mainly deals with securities like shares, bonds, and debt market is related with debentures or borrowings or loans. And then again, equity market can be classified into three types of market. One is primary market, next is secondary market, and third is derivative markets. Derivative means which is derived from the other source of market. So equity market can be classified into three parts. One is primary, next is secondary, and third is derivative markets. And in money market, we include treasury bills, call money market, commercial bills, and certificates of deposits. Treasury bills are those bills which are issued by central government of India, and these bills generally issued by government for short term funds, for collecting short term funds. So the all the things which is related with short time period, that is included in money market, because money market deals with short time period funds, and capital market is related with longer time period funds, in which equity and debts are included. And equity market can be classified into three types: primary, secondary, and derivative markets. And in money market, we include commercial bills, treasury bills, call money market, and certificates of deposits. So this is the basic uh, types of financial markets, in which two types of market we can take. One is capital and other is money market. Now next is whole financial system can be classified into four main groups. One is financial institutions, because financial system is a very broader concept, and in financial system, all financial things like financial concepts like financial institutions, financial markets, financial instruments, financial services, all things are included in financial system. So financial system, which is a very broader concept, can be classified into four different groups. One is financial institutions. Now, what are the financial institutions? Financial institutions, in this we include banking system. You know that banking system is that system which take money from the savers and give it to the users or investors, those who need money for their business enterprises and production of goods and services. So bank is an institution which play as a role of intermediaries, which take money from the lenders and give it to the borrowers, and in between bank get profit, because when bank lend money from the savers, give less rate of interest, and when bank give that money to the borrowers, bank charge high rate of interest. And bank provides so many other services also, beyond that savings and investment. Other services bank also provide, and bank take charges to provide all these services. That is the main profit of banking institution. So in financial institution, we include banking, non-banking system, developmental, regulatory, and others. All these are included in financial institutions. And in financial market, there are different types of financial market. One is organized, other is unorganized. Means financial market may be organized, may be unorganized. Financial market may be primary, may be secondary. Financial market may be money market or capital market. You know, money market deals with shorter time period funds, and capital market deals with long time period funds. Primary market is that market which mainly perform work for providing financial facilities, and secondary is the other form of financial market. Organized, which is well organized, well developed by the government sector, and unorganized, in which private sector play very important role. So financial system under this financial markets can be classified into different categories. And in financial instruments we include two types of instrument. One is money market instrument. Money market instrument, in this we include treasury bills, commercial bills, certificates of deposits, etc. And in capital market instrument we include equity and debt, and also we include primary market, secondary market, derivative market, etc. So money market, capital market instruments based on short time period, medium time period, and long time period. Financial services, in this, who provide financial services? You know that banking system provide financial services, merchants provide, merchant banking system also provide financial services, some brokers or brokerage who takes commission for providing these financial services. So brokerage also providing financial services, underwriting, consultants, credit rating, discount houses, acceptance houses, and market makers. All these provide financial services. So this is the whole financial system, which is classified into four main groups. Now next is structure of financial market in India. In Indian financial market system, here basically Indian financial market is classified into two major or broad categories. One is money market and other is capital market. Money market deals with short time period funds and capital market deals with long time period funds. If you want to take longer time period funds for your business enterprises, then you can take money from capital market. But if you need money for a shorter time period, then you can collect it or take it from the money market. So money market in this treasury bills is known as T-bills, call money, hundis. Hundis are also a paper document which is written by the person who are giving promise to pay amount in future. Mutual funds and IPO, all these things, all these instruments are in belongs to money market system, because all these instruments are based on the shorter time period funds. So money market play very important role, and capital market also play very important role, because both the markets are needed in Indian financial market system, because both market play different roles. One is giving us shorter time period funds and other is giving us longer time period. Those who need money for the long time period, they will take that money from capital market, and those who need money for short time period, they will collect it or take it from money market. So this is the structure of financial markets in India. Now next is functions of financial markets. Now what are the various functions of Indian financial markets? Financial market. First of all, market is a place where buyers and sellers meet together and buy and sell their products. Same as there are so many types of market, like one is goods market where goods are sale or purchase. Another is money market where money can be sale or purchase. Next is labor market where labor can be used for production of goods and services. Labor can be sold or purchased. So financial market perform very important role in channeling funds from economic players that have saved surplus funds to those that have a shortage of funds. So funds can be mobilize from surplus to shortage, and financial market perform the essential function or important function of channeling funds or mobilizing funds from economic players that have saved surplus money in these financial market, and these funds give it to the those person who have a shortage of funds. In this case, funds can be mobilized, funds can be fully utilized. Next is, in case of deficit finance, borrowers can borrow funds directly from lenders in financial market by selling them securities. And financial market promotes economic efficiency by producing an efficient allocation of capital, which increases production level, and it directly improves the well-being of the consumers by allowing them to time purchases better. So financial market play very important role in between of surplus of funds and shortage of funds. Financial market provide surplus funds to the uh, those persons who have shortage of funds. Financial market play very important role to increase in economic efficiency by producing an efficient allocation of capital, which increases the production level. When production increases, employment opportunities will generate, investment will increase, income will increase, economy will grow, and economic development will be possible, and it directly improves the well-being of the consumers also by allowing them to time purchases better. So these are the main functions of financial markets. Now next is Indian financial system. Indian financial system may be formal organization, formal financial system, or it may be informal financial system. So Indian financial system can be classified into two parts. One is formal financial system, other is informal financial system. In a formal financial system, again we can classify it into two categories. One is regulators. Who are the regulators of formal financial system? RBI is the regulator. RBI means Reserve Bank of India, who is the apex institution of monetary authority. And SEBI deals with the securities, shares, bonds, etc. And IRDA, Indian Regulation Development Authority, and MOF, Memorandum of Funds. So all these are the regulators of formal financial system, and components. What are the components of this financial system? Financial institutions, financial markets, financial instruments, and financial services, which we have studied in previous slides, that components, mainly components of formal financial system can be classified into four parts. One is financial institution, next is financial markets, next is financial instruments, and financial services. Now, informal financial system, which is known as non-institutional source of finance, in which individual money lenders are deals with this market system, groups of person operating as funds, partnership firms, all these which are not organized, managed, or controlled by government, that financial system is known as informal financial system. And the system which is fully organized, managed, and controlled by Government of India, that is called formal financial system. So this is the basic difference between formal and informal financial system. Informal financial system deals with unorganized, or deals with individual person or individual money lenders, groups of persons, or partnership firms, etc. Now, next is formal and informal financial system. Formal financial system is characterized by presence of an organized, institutional, and regulated system which caters the financial needs of the modern spheres of the economy. An informal financial system is an unorganized, non institutional, and non regularized by government dealing with the traditional system and rural spheres of the economy. So, in modern time period, at present time period, formal financial sector, which is well organized, well institutional, well regulated system by the government is going on at present. This system is exist at in present time period. And informal financial sector deals with unorganized. It is unorganized, non-institutional, non-regularized system deals with traditional and rural spheres of the economy. So this is the two types of financial system. One is formal and other is informal. Now next is banking system in India. In India, first of all the banks are managed, controlled and organized by Reserve Bank of India. So Reserve Bank of India is the apex institution of monetary authority in India. Reserve Bank of India works with different types of banks like commercial banks, cooperative banks, regional, rural banks. One is commercial bank. Commercial banks again can be classified into private commercial banks, public sector commercial banks, nationalized commercial banks, and scheduled banks, non-scheduled banks, cooperative societies, regulated or regional rural banks which deals with the rural areas and which provide financial funds, uh, financial facilities to the farmers for producing their crops for the short time period, long time period, and medium time period, all types of different time period, all funds provided by regional rural banks in rural areas for supporting farmers. Now next is RBI. In this we can categorize different forms of banks in scheduled and unscheduled banks. In scheduled banks we can take commercial banks and cooperative banks, and then again commercial banks may be public sector banks, private sector banks, foreign sector banks, and regional rural banks. So these are the different categories of banking system in which RBI fully controlled all types of banking system. Either it may be scheduled or unscheduled. In scheduled, commercial banks, cooperative banks are controlled by RBI. In commercial banks, banks may be private sector bank, bank may be government sector bank may be foreign banks, and regional rural banks. All banks are controlled or managed by Reserve Bank of India. Now next is what is the main function of banks? What functions or what are the main or various functions which is performed by banking system? You know that Reserve Bank deals with the organization, management and controlling. It's a regulatory authority, and Reserve Bank controls the credit process, credit creation process, and control the money supply. RBI deals with banking system, but commercial banks deals with public. Commercial banks mainly accept deposits from the individual or corporate sectors, etc. Banks accept deposits and provide loans to the borrowers, individuals, corporate sectors, RBI, other banks, financial institution. Bank can give loan and advance facilities to the producing or farm sector or other sectors. So borrow money, you can borrow money from banks, borrow money from financial institutions, RBI, other banks, etc. And bank can provide loans to the individual, corporate sector, other banks and financial institutions. Regulatory bank works as a regulatory function in which cash reserve ratio, which is fixed by the Reserve Bank of India, that lies in between of 5 to 6%, and statutory liquidity ratio, which is known as SLR, is near about 24%, and the other investment is mutual funds investment and investment in bonds, securities, and trading and foreign exchange operations, etc. And banks, the raise funds in debts, equity, foreign markets goes to banks, and bank can provide so many other services like debit card, credit card, current savings, demat account, syndication services, merchant banking services, etc. So these are the main functions of commercial banks. Now, functions of banks can be classified into two main parts. One is primary function, other is secondary functions. In primary function, the main function of the bank is accepting deposits, providing loans and advance facilities. Bank can work as an agent and utility functions. In accepting deposits, bank can accept deposits from the savers or from the lenders, like saving deposit, current deposits, fixed deposits, and recurring deposits. Granting loans and advance facilities in this overdraft facility, cash credit, loans, and discounting the bills, these are included in providing loans and advance facilities. Next is agency function. In this, bank work as an agent. Bank play important role as a middleman or intermediaries. Bank can transfer your funds from one organization to another organization. Bank can give payment on behalf of you, and payment may be periodic, and bank can collect checks and portfolio management. Portfolio is shares, paper title document, investment. Bank can manage portfolio, investment, periodic collections, and other agency functions bank can perform. And utility functions, in this, bank can provide draft facility, lockers facility, in which you can keep your gold and other precious items in lockers safely, and underwriting, project reports, social welfare programs, and other utility functions can be provided by banking system. So these are the functions of commercial banks, and these functions classified into two main parts, primary and secondary. And in primary, two main functions are included. One is accepting deposits, other is providing loans and advance facilities. And in secondary function, here utility function and agency function both are included. Now next is RBI. You know that RBI is the apex institution of monetary authority. The Reserve Bank of India Act 1934 commenced on April 1st, 1935. The Act 1934 provides the statutory bodies and statutory basis of the functioning of the bank. The bank was constituted with the following objectives broadly. One is bank, RBI, or it is known as central bank. The main Purpose of the RBI is to regulate the issue of bank notes, to maintain reserves with a view to securing monetary stability, and to operate the credit and currency system of the country to its advantage. So the main purpose of RBI is to regulate the whole currency of the country and to maintain the minimum reserve, which is very required for issuing paper currency, and to operate the credit and currency system of the country to its advantages. And the main objective of RBI is the primary objective of financial supervision. First main function is RBI can supervise all the banks, either it may be scheduled or unscheduled, commercial, cooperative, and regional rural banks. All the banks, either it may be private sector bank, public sector bank, foreign banks, and regional rural banks, all banks works under the guidance of, under the supervision of Reserve Bank of India. So the main primary objective of Reserve Bank of India is that Bank RBI supervise all the financial sector banks, commercial banks, financial institutions, and non-banking financial companies. And the main function of Reserve Bank of India is to issue paper currency or coins or notes, etc. RBI is a monetary authority. It regulates and supervises the whole financial system. RBI manage foreign exchange rate, and RBI manage the foreign exchange system. And RBI is the main power or monopoly power of issuing paper currency, and it play very important role in the development of the country also. So these are the main objective and functions of Reserve Bank of India. Now next is functions of RBI. There are so many functions of Reserve Bank of India. Like one is issue of currency. Reserve Bank of India first of all has a monopoly power of issuing paper currency, coins, notes, etc. Only 1 rupee note is issued by Ministry of Finance, Government of India. Rest of the other currencies and coins are issued by Reserve Bank of India. It plays a very important role in the development of the whole banking system and the development of the whole country. RBI is the bankers' bank, and RBI is the bankers to government, bankers' bank, and RBI can control inflation or deflation situation which occur during time to time, and at the time of inflation RBI can control inflation rate by using instruments like qualitative and quantitative, which are very necessary to control the economic conditions like inflation or deflation. Inflation is a situation when price rises continuously for the longer time period, and deflation is a situation when price falls continuously for the long time period. Inflation is when inflation increases at a very fast rate, then economy will reach at a hyperinflation situation, and hyperinflation is really a bad situation for the economy. And deflation is also very bad for the economy, because at the time of deflation, when prices falls, at that time producers will not encourage to produce goods and services. When they will not produce goods and services, then investment will fall, production will fall, employment will fall, income will fall, purchasing power of the consumer will fall, and demand will again fall, and economy will go in the situation of depression, and that is very bad for the economy. So RBI play very important role in controlling these situations like inflation or deflation, and RBI formulate monetary policy. RBI is the manager of foreign reserves, all the foreign currencies which is received by our country for doing exports. RBI manage all the foreign reserves, and RBI play a role of clearing house functions and regulatory. RBI is the regulator of whole banking system. So these are the main functions of Reserve Bank of India. Now, functions of Reserve Bank of India broadly it can be classified into four main groups. One is traditional function. Traditional functions are same as like issuing paper currency, bankers bank, government bank, and RBI is the manager of financial reserves. And next is promotional and development functions, other functions, and prohibitory function is that function which is prohibited. It means RBI can prohibit or can restrict some things which is not done by commercial banks. So these are the main four functions of RBI. Now, first is issuing of currency. RBI play very important role in issuing paper currency, coins, notes, etc. RBI designs, printing and distribution, and issuing paper currency for making uniformity in currency. That's why RBI has a monopoly power of issuing all paper currencies, coins, notes, etc. Only 1 rupee note is issued by Ministry of Finance, Government of India. Rest of the other currencies are supplied by or issued by Reserve Bank of India. Next is monopoly of note issue. RBI manages circulation of money through currency. Originally, RBI issued currency notes of rupees 2 and above. However, due to higher cost of printing small denomination notes, these denomination are now coincides and issued by government. And currency chest are receptacles in which stocks of issuable and new notes are stored along with rupee coins. You know that RBI has to maintain a minimum reserve system in which 200 crore rupees has to kept for issuing more paper currency, coins, notes, etc., in which 115 crore rupees gold and 85 crore rupees foreign exchange are kept with RBI, and RBI keep this amount for issuing paper currency. That reserve system is followed by Reserve Bank of India. Why this system is followed by Reserve Bank of India? This system is followed by RBI to maintain stability in issuing paper currency, to maintain stability in price level, to maintain stability in foreign reserve system. That's why RBI always follow this minimum reserve system. Otherwise, if RBI issues more paper currency, more notes and coins, etc., then circulation of money will increase. When circulation of money will increase, it will increase in the price level in the economy, and it will create the problem of inflation. And at the time of inflation, then purchasing power of the money will fall, or value of money will fall, and consumers will be affected badly or adversely by increasing the more supply of money due to this inflation problem. So RBI has to manage the control over, or RBI has to manage the money supply. Money supply must be equals to money demand, not more than that and not less than that. Because reason is, if we want to keep price stable and if we want to stabilize price stability, then RBI must issue paper currency according to the need of the public. Money demand and money supply must be equal, not more than that. Next is development and promotion work. RBI has been aiding development and promoting savings and banking habits, development of the institutional, agriculture, and other rural activities has been an area of focus right from its inception. So, RBI can promote all the economic sectors like primary sector, secondary sector, and tertiary sector, and RBI can develop and RBI can promote all the rural areas activities by providing loans and advance facilities at lower rate of interest. Next is supervisory function. RBI can grant license to banks. RBI can cancel license to any bank, and the RBI can also provide grant licensing to the banks. RBI of India perform the following supervisory function. By these functions, it controls and administers the entire financial and banking system of the economy. RBI can grant license to the banks which like to commence their business in India. Licenses are also required to open new branches or closure of branches with this power. RBI can ensure avoidance of unnecessary competitions among banks in particular location, evenly growth of banks in different regions, adequate banking facilities to various regions, etc. So this power also helps RBI to weed out undesirable people from starting banking business. Next is publishes economic statistics and other informations. Reserve Bank of India collects data on economic and financial matters. It publishes periodically an analytical account of the operation of joint stock and cooperative banks. It presents the genuine financial positions of the government and companies. The publications like the report on currencies and finance and the report on the trend and progress of banking in India, the review of cooperative movements present a critical account and a balanced review of banking developments, commercial, economic, and financial conditions of the country. Bank RBI work as an agent and advisor of the government. RBI acts as the financial agent and advisor to the government. It renders the following functions like as an agent, it accepts loans and manages public debts on behalf of the government. It issues government securities, bonds, treasury bills, etc. Act as the financial advisor to the government in all important economic and financial matters. And promotional functions, RBI can promote banking habits and expansion of the banking system territorially and functionally. RBI has set up Deposit Insurance Corporation in 1962, Unit Trust of India in 1964, IDBI in 1964, the Agricultural Refinance Corporation in 1963, Industrial Reconstruction Corporation of India in 1972, NABARD, which provide loans and advance facilities to the agriculture sector in 1982, and National Housing Bank in 1988. So it has helped to bring into existence several industrial finance corporations such as Industrial Finance Corporations of India, Industrial Credit and Investment Corporation ICICI for industrialization of the country. Similarly, sector services specific corporations took care of developmental in their respective spheres of activity. So RBI can easily control the inflation situation of the economy. RBI has some instruments like qualitative and quantitative instruments which can control the inflation and deflation problem which exist in the economy. So RBI play very important role in India. Rest of the topic of this blog we will discuss in next session. So in this session we have discussed about financial sector, financial system of the economy and financial system, how it works, what are the main functions and objectives of this financial system and what role which is played by Reserve Bank of India. Thank you.